In this video, we are looking at the support and resistance zones and how they can be manipulated by the market makers by inducement of liquidity and then liquidity run or stop loss hunting. In essence, retail traders would have placed their stop losses. Since this is a zone, resistance zone, most probably there would be some stop losses here and then, so retail traders are looking to put another stop loss here. Since they would enter their trades here, then the stop loss here, with anticipation of the market coming to the resistance zone and then falling down. Now, market makers will manipulate these stop losses by giving a false breakout and then taking an aggressive move down. So this is the liquidity. So this zone turns to be the liquidity as now similarly, this support zone will also have some stop losses by retail traders mostly at these support areas, and they are anticipating that the market will probably go to resistance, come to support, and then maybe go up. So market makers are looking at this zone as a liquidity zone. So they are interested in manipulating these stop losses by giving a false breakout before an aggressive buy to the upside, after taking out most of the retail traders and making an aggressive move. One way to avoid being liquidated is having a stop loss a little further from the zone. Would be like this, but it cannot be approximated well because sometimes it can extend to that level. So the best way to enter as a retail trader is to wait for this stop loss hunting. Once it has been manipulated, you can now join the big banks and the big institutions, the market makers, in taking your buy position. After this, you enter and then you move with them. So for example, if you're taking a buy, so at this level you now enter here. This will be your first take profit and will still extend depending on other parameters. Now let's look at the real example in the market. This is GBP USD and we're looking at 1 hour time frame. So this is equal high. Retail traders would be looking at this zone as a resistance zone where market comes and rejects. It's rejected, they take their sales. Stop losses are placed. Most of the stop losses are here. This could be stop losses. So this becomes a liquidity zone in that case, and therefore the market makers or the big players would liquidate these retail traders who are taking sales and putting their stop losses at the zone by making a false breakout and then for liquidity grab and then taking a massive move on the sell side. So as a retail trader, you wait for the aggressive move, a false move to the upside to take out this liquidity, and then you look for sell opportunities now after the liquidity has been taken here. So let's have a look at what happened next. So you wait patiently. Good one. Now this is a week of a false breakout that seems like the market was on a breakout but was quickly returned, and this is a very perfect example of a manipulation where it leaves the wick and not closing above this zone. So in this case, you now prepare to enter the trade, and if you're an aggressive trader, you can take your entry here, and the stop loss should be immediately above this candle, and your first, of course you can take your first profits here, partials, you can add another, then you can move to the next level, you can take another partials there, then you let the rest to run to this zone. So this is a risk reward of 1:6. Of course it can be more, but you can just take your profit at that level. Let's see what happens next. Perfect, you hit your take profit.